Breaking news: if you've got just £3,500 sitting in a savings account, you could soon be receiving an unexpected letter from HMRC, and no, this isn't a joke. Even small savers are now being targeted with surprise tax bills, and the reason might shock you. Before we dive into this important update, make sure to subscribe to my channel so you never miss crucial financial news that could impact your wallet. Now, let's get into it. That's right, thousands across the UK are now at risk of being hit with surprise tax bills, and the reason might seem shockingly small: your savings. If you're thinking, surely, I don't have enough money in the bank to worry about the taxman, think again. Under current rules, even modest savers could be crossing thresholds that trigger tax obligations, all without even realizing it. And with the 2025-2026 tax year now well underway, Revenue and Customs is already sending out demand letters to individuals whose savings interest has quietly crept past the allowed limits. If you think this doesn't apply to you, stick around because it very well might. So how is this happening, and why now? Well, let's start with what HMRC actually looks at. Thanks to automated reporting systems, banks and other financial institutions now send information directly to the tax office, meaning HMRC knows exactly how much interest you've earned each year. They compare that interest to something called your Personal Savings Allowance, a tax-free limit on the interest you can earn each year from savings, and if you've gone over, even by a few pounds, a tax bill may be on its way to you. You won't need to do anything to alert them, they already know. Now, let's talk about what these Personal Savings Allowance rules actually mean. If you earn up to £50,270 per year, you're allowed to earn up to £1,000 in interest from your savings without paying any tax on it. Sounds simple, right? But once your income hits £50,271, that tax-free allowance is slashed in half to just £500. And if your income reaches £125,140 or more, your allowance is completely wiped out down to zero. In other words, even if your savings are modest, your income level could trigger a tax charge, and it's catching many people off guard. What's especially surprising is how little money it takes to go over that limit. For example, let's say you've got £3,500 in a fixed-rate savings account earning 5% interest per year, and it's locked in for 3 years. Over that time, you'll accumulate just over £500 in interest. But here's the catch: fixed-rate accounts usually pay out interest in one lump sum at the end of the term. So even though the money accumulated over 3 years, the interest is all paid at once, and HMRC sees it as income in a single tax year. That pushes you over your £500 allowance in one go, and just like that, you could receive a tax demand letter. Let's break it down even further. On £3,500, at 5% interest for 3 years, you'd earn about £525. That might not sound like a huge return, but because it's all paid out in a single payment, HMRC counts that entire amount as interest income for one tax year. If your allowance is only £500, that extra £25 is taxable. And depending on your income tax bracket, the rate you pay on that interest will vary. Basic rate taxpayers, those earning up to £50,270, pay 20% on the excess. But if you're in the higher rate tax bracket earning between £50,271 and £125,140, then you'll pay 40%. That means going just £100 over your savings interest allowance could cost you £40 in tax. And if you're in the additional rate band earning more than £125,140, your allowance is zero, and all your savings interest is taxed at 45%. Even those with more typical savings habits aren't immune. Say you have £11,000 in an easy access account earning 5% annually. Over the course of a year, you'd earn £550 in interest, exceeding the £500 allowance for higher rate taxpayers. That alone could trigger a tax charge from HMRC. And if you're a basic rate taxpayer with savings of £21,000 at 5%, you'll generate £1,050 in interest in 1 year, £50 over your £1,000 allowance, which also makes you liable for tax. But it doesn't stop at bank accounts. The Personal Savings Allowance covers a wide range of interest-bearing sources, many of which people don't often associate with tax obligations. The government lists a variety of financial products that could potentially add to your taxable interest. These include building society accounts, credit union savings, unit trusts, investment trusts, open-ended investment companies, peer-to-peer lending, trust funds, government or corporate bonds, life annuity payments, PPI compensation that includes interest, and even some life insurance contracts. Any interest earned from these sources counts toward your total, and once you go over the threshold, the taxman wants a slice. So, how will you know if you've crossed the line? That's where HMRC systems come into play. If you're employed or receive a pension, HMRC often adjusts your tax code to collect any owed tax automatically. They do this by estimating how much interest you're likely to earn in the current year based on your previous year's figures. This means even if your savings situation changes, for example, if you withdraw funds or move them into a non-interest-bearing account, your tax code might still be altered preemptively, potentially leading to overpayments or confusion. Alternatively, if you're self-employed or your tax situation is more complex, HMRC may ask you to register for self-assessment. That means you'll need to report your own income and interest, and pay any tax due directly, often through a payment on account system that spreads the cost into 2 or more payments over the year. And let's be honest, most people don't want the hassle of self-assessment unless absolutely necessary. There's also a common misconception that as long as your savings are under £10,000 or so, you're in the clear. But as we've just shown, the combination of high interest rates and lower personal savings allowances, especially for higher earners, means even relatively small balances can breach the limit. And with many savings accounts now offering rates of 5%, the chances of triggering a tax bill are higher than they've been in years. So, what can you do to avoid this unexpected headache? First, make sure you know your tax band. If your income is approaching or above the £50,270 threshold, you'll need to be much more cautious with how your savings interest adds up. Secondly, consider using tax-efficient savings vehicles like ISAs, individual savings accounts, especially cash ISAs, which are completely tax-free regardless of how much interest you earn. Unlike standard savings accounts, the interest in ISAs doesn't count toward your personal savings allowance at all. That makes them an excellent option for higher rate or additional rate taxpayers looking to shelter their returns from tax. You should also review how and when your interest is paid. If you're using fixed-term products, remember that interest paid at the end of the term is all counted in a single tax year. If you split your savings across multiple accounts or stagger maturity dates, you might be able to stay under the threshold more easily. And of course, keeping detailed records and checking your annual bank interest summary can help you catch any potential tax issues before HMRC does. In conclusion, the days of assuming your savings are too small to be taxed are over. With tighter allowances, rising interest rates, and a growing reliance on automated systems, HMRC is better equipped than ever to track down unpaid tax on savings, even from everyday savers. Whether you've got £3,500 or £30,000 tucked away, it's now more important than ever to understand how your interest is taxed, where your income falls in relation to the thresholds, and what steps you can take to avoid unpleasant surprises in the post. The bottom line? Your savings might be working for you, but they might also be working for the taxman. So stay informed, stay smart, and make sure your money is protected not just from inflation, but from unnecessary tax bills as well. And if you found this breakdown helpful, make sure to hit that like button, leave a comment with your thoughts or questions, and most importantly, subscribe to the channel so you never miss an important financial update. Thanks for watching, and I'll see you in the next video.